Global Monetary Watch brings you the July 29th update. Today we're taking a careful look at several developments that have sparked intense discussion across the Iraqi Dinar and Vietnamese Dong communities. Headlines circulating online have suggested that major changes involving exchange rates, central banks, and even one of the world's largest financial institutions are all connected. Rather than relying on speculation, this report focuses on documented information, institutional actions, and publicly available developments. Our goal is to separate verified facts from popular assumptions while providing a balanced overview of what is actually taking place and why these developments are receiving so much attention. One of the biggest reasons this story has gained momentum is the involvement of JP Morgan, a financial institution whose global influence naturally attracts attention whenever it expands its operations. Many online discussions have linked the bank's activities to claims about immediate currency changes for both the Iraqi Dinar and the Vietnamese Dong. However, the important question is not whether JP Morgan is active in these markets. It is what those activities actually represent. Understanding the difference between a commercial banking expansion and an official monetary policy decision is essential before drawing conclusions about either currency's direction. Although the Iraqi Dinar and Vietnamese Dong are frequently mentioned together, it is important to recognize that two currencies can appear in the same discussion for very different reasons. Sometimes they share genuine institutional similarities, while other times they are grouped simply because both attract interest from international currency communities. A responsible analysis examines whether there is evidence showing that the two currencies are truly connected through coordinated policy, or whether they are simply following separate paths that happen to receive attention at the same time. Making that distinction helps prevent misunderstandings and encourages a more accurate interpretation of current events. Looking first at Iraq, recent years have seen continued efforts to modernize the country's banking system and strengthen compliance with internationally recognized financial standards. The Central Bank of Iraq has introduced measures designed to improve transparency, strengthen anti-money laundering controls, enhance monitoring of financial transactions, and encourage greater confidence in the banking sector. These reforms are part of a broader modernization effort that has been underway for several years. While these initiatives require significant time to implement, they represent documented institutional changes rather than short-term announcements intended to produce immediate currency adjustments. JP Morgan's increasing engagement with Iraq should be viewed within this broader context. Large international banks do not expand correspondent banking relationships without conducting extensive reviews of regulatory compliance, operational procedures, and financial risk. When a global institution decides to deepen relationships within a country's banking sector, it generally reflects confidence that the local financial infrastructure is meeting higher international standards. This does not automatically signal a new exchange rate or a currency revaluation. Instead, it suggests that reforms have progressed sufficiently to support greater international banking cooperation under existing regulatory requirements. Vietnam presents a different economic picture altogether. The State Bank of Vietnam operates under monetary objectives that differ significantly from those of Iraq. Vietnam's economy has relied heavily on manufacturing exports, making exchange rate stability an important component of its long-term economic strategy. Policymakers have historically managed the value of the Vietnamese Dong in a way that supports export competitiveness while maintaining overall financial stability. As a result, discussions surrounding the Vietnamese currency must be evaluated within the framework of Vietnam's own economic priorities, rather than being compared directly with Iraq's financial reforms. JP Morgan has also expanded aspects of its presence within Vietnam's financial sector, and this development has generated similar speculation. However, the evidence indicates that this expansion reflects growing confidence in Vietnam's banking infrastructure and continued economic development rather than confirmation of a dramatic currency event. As Vietnam's financial system becomes more integrated with international markets, global financial institutions naturally increase their engagement where commercial opportunities exist. That process mirrors broader trends seen across many developing economies that continue improving regulatory standards and strengthening financial oversight. One phrase that often captures attention in online discussions is the claim that a new exchange rate has been released. It is important to understand how official exchange rate publications actually work. The Central Bank of Iraq routinely publishes exchange rate information as part of its normal operations. These regular updates are standard institutional practice and should not automatically be interpreted as evidence of a major policy shift. Careful analysis requires comparing any published figures with previous official data to determine whether meaningful changes have occurred or whether the updates simply reflect routine daily operations within an established monetary framework. When these developments are viewed together, a clearer picture begins to emerge. Iraq and Vietnam are both strengthening their banking sectors, but they are doing so for different economic reasons and under different monetary policies. JP Morgan's involvement in each country appears to reflect confidence in improving financial infrastructure rather than confirmation of coordinated currency changes. The more significant story is the continued effort by both countries to align portions of their banking systems with international standards. While this progress is meaningful from an institutional perspective, it should not be confused with official announcements regarding exchange rate policy. Understanding that distinction allows viewers to evaluate current developments using documented evidence instead of relying solely on widely circulated interpretations. As the discussion continues, one of the most important observations is that the similarities between Iraq and Vietnam lie primarily in the modernization of their banking systems rather than in synchronized currency policies. Both countries have invested considerable effort into improving regulatory oversight, enhancing compliance procedures, and strengthening relationships with international financial institutions. These reforms are designed to make their banking sectors more reliable and transparent within the global financial system. While these parallel developments are noteworthy, they should not be interpreted as evidence that both currencies are following the same monetary path or preparing for identical policy outcomes. For Iraq, banking reform remains closely tied to the Central Bank of Iraq's long-term objective of improving financial stability. Measures aimed at strengthening anti-money laundering controls, expanding digital payment systems, increasing transparency, and encouraging wider participation in the formal banking sector have continued to receive attention. These initiatives are intended to improve confidence in the country's financial infrastructure and create a more efficient banking environment. Although such reforms can contribute to stronger institutional credibility over time, they do not by themselves constitute official announcements regarding changes to the Iraqi dinar's exchange rate. Financial inclusion has also become an important component of Iraq's broader economic strategy. A significant share of everyday transactions has historically taken place outside the formal banking system, limiting the effectiveness of monetary policy and reducing visibility into overall financial activity. To address this challenge, authorities have encouraged electronic payment systems, expanded banking services, promoted digital salary distribution, and supported greater use of financial technology. Each step that brings more economic activity into regulated financial channels improves transparency and strengthens the banking system's ability to operate according to internationally recognized standards. Reducing dependence on cash transactions provides benefits beyond improved record-keeping. A larger formal banking network enables financial institutions to monitor transactions more effectively, enhances regulatory oversight, and supports compliance with international banking requirements. These gradual improvements are often less visible than dramatic headlines, yet they represent some of the most meaningful structural developments occurring within Iraq's financial sector. While progress is measured over years rather than days, these institutional reforms contribute to a stronger financial foundation that international banking partners evaluate carefully before expanding their involvement. Global economic conditions also influence how central banks manage their currencies. Interest rate decisions by major central banks, movements in the value of the US dollar, and changing conditions in international financial markets all affect countries that maintain managed exchange rate systems. When the dollar strengthens globally, many central banks face additional challenges in balancing exchange rate stability with domestic economic objectives. Iraq and Vietnam each respond according to their own economic priorities, but both operate within a broader international financial environment that influences monetary policy decisions across many developing economies. Vietnam's situation illustrates how different economic models require different monetary strategies. As one of Asia's major manufacturing and export-driven economies, Vietnam has historically prioritized maintaining competitive pricing for its products in international markets. Exchange rate management therefore serves multiple purposes beyond domestic monetary stability. A currency that changes too rapidly can affect export competitiveness, foreign investment decisions, and broader economic planning. Consequently, the State Bank of Vietnam generally approaches exchange rate management with long-term economic objectives in mind, rather than focusing on sudden policy adjustments that could disrupt established trade relationships. This distinction is especially important when evaluating speculation surrounding the Vietnamese Dong. While Vietnam has continued strengthening its banking system and attracting international financial participation, These developments should not automatically be interpreted as indicators of an imminent upward currency adjustment. Improvements in banking infrastructure, regulatory compliance, and correspondent banking relationships reflect institutional progress, but monetary policy decisions continue to be shaped by Vietnam's export-oriented economic framework. Understanding that broader context helps explain why banking reforms and exchange rate policy should be analyzed as related yet separate aspects of the country's financial development. When examining Iraq and Vietnam side by side, the strongest connection between them is not the expectation of simultaneous currency changes, but the shared effort to improve financial credibility through institutional reform. Both countries have worked to strengthen compliance standards, modernize banking operations, and deepen integration with international financial systems. J.P. Morgan's expanding engagement reflects recognition of those improvements rather than confirmation of coordinated exchange rate actions. By separating documented institutional progress from unverified market speculation, viewers gain a clearer understanding of what current developments genuinely represent, and why careful analysis remains essential when interpreting major financial news. Looking ahead, Iraq's broader economic reform agenda continues to provide important context for understanding developments within its financial system. Government initiatives aimed at strengthening public finances, improving infrastructure, encouraging private sector participation, and modernizing state institutions have gradually moved from planning into implementation across multiple sectors. While the pace of these reforms varies, each step contributes to building a more resilient economic environment. Observers often focus on exchange rate discussions, but many economists argue that sustainable financial progress depends just as much on institutional reforms, effective governance, and long-term economic diversification as it does on monetary policy alone. Another important area receiving increased attention is Iraq's foreign reserve position and its ability to support monetary stability. Central banks around the world rely on reserves to help manage exchange rate policies, maintain confidence in the financial system, and respond to periods of market volatility. Iraq's ongoing efforts to strengthen fiscal management, supported by energy revenues and broader economic reforms, have contributed to maintaining a financial buffer that supports the central bank's operations. These developments are significant because they reinforce the country's financial resilience, even though they should not be interpreted as direct evidence of an imminent change in official exchange rate policy. The international financial environment also plays a major role in shaping the outlook for both Iraq and Vietnam. Decisions made by leading central banks, fluctuations in global energy markets, inflation trends, and changes in international investment flows all influence economic conditions across emerging markets. Countries with managed exchange rate systems must continually adapt to these external pressures while balancing domestic priorities. As a result, developments affecting the US dollar or global interest rates can influence monetary policy decisions indirectly, making it important to evaluate local reforms within the context of wider global financial conditions rather than viewing them in isolation. When considering the Iraqi dinar specifically, the most consistent evidence points toward a continuing process of institutional improvement rather than sudden transformation. Banking sector modernization, stronger compliance standards, greater financial inclusion, narrowing differences between official and market conditions, and expanding international banking relationships collectively indicate ongoing structural progress. Each development contributes to strengthening confidence in Iraq's financial framework over time. However, none of these individual factors should be confused with an official announcement regarding a new exchange rate, as monetary policy decisions remain the responsibility of the Central Bank of Iraq and are communicated through official channels. The Vietnamese Dong follows a different economic path shaped by Vietnam's long-standing focus on exports, manufacturing growth, and international trade competitiveness. Although the country's banking sector has become increasingly sophisticated and continues to attract greater participation from global financial institutions, its monetary policy remains aligned with supporting broader economic objectives. Improvements in financial infrastructure demonstrate institutional advancement, but they do not necessarily imply that Vietnam is preparing for dramatic changes to its exchange rate framework. Evaluating the Dong on its own economic fundamentals provides a more balanced understanding than combining its story with unrelated narratives surrounding other currencies. Bringing all of today's developments together, the central message is one of institutional progress rather than extraordinary monetary events. J.P. Morgan's growing engagement with financial institutions in both Iraq and Vietnam reflects increasing confidence in banking sector reforms and regulatory improvements. Meanwhile, the Central Bank of Iraq and the State Bank of Vietnam continue pursuing policies designed to strengthen their respective financial systems according to each country's unique economic priorities. While similarities exist in the modernization of their banking sectors, the available evidence does not support treating both currencies as though they are following a single coordinated path toward identical exchange rate outcomes. As always, staying informed begins with relying on verified information rather than speculation. Official statements from central banks, documented financial reports, and publicly available institutional updates remain the most reliable sources for understanding developments affecting the Iraqi Dinar and Vietnamese Dong. Here at Global Monetary Watch, our commitment is to examine those developments carefully, present them with context, and distinguish confirmed information from unverified claims. Thank you for spending your time with us today. If you found this update helpful, be sure to subscribe to Global Monetary Watch, turn on the notification bell so you never miss an update, and share your thoughts in the comments below. We appreciate your support, and we'll see you in the next report.